Stock Markets for Beginners, Part 7. This is probably my favorite section within the entire course. We're going to talk about how to analyze and value a stock. We're going to break down what income statements are, what cash flow statements are, what balance sheets are, information that you need to know if you're trying to be an individual investor. We're going to talk about how they actually communicate with one another and how you can use that information to build a complete picture of the financial health of an investment that you're looking into. This is really exciting stuff. So I just can't wait for you to learn this section. So let's just go ahead and jump right in. How to analyze a stock. This is where things get very exciting, but also pretty complicated. So I want you to hang in here with me. You might have to watch this section a couple times. There's no shame in that. You might have to watch it at half speed. There's no shame in making sure you understand this, because this is a true case of knowledge is power. Because once you understand how to actually analyze a stock, this is when you turn into a real investor, especially if you're trying to do individual stock picks. You want to be able to tear a company apart and look at the inner workings and understand the financial health of a company. And that's what we're going to cover here, at least the basics as to how you get started with it. So we're going to first cover fundamental stock analysis, and this is going to be quite a large section. And then we'll cover technical analysis a little bit after that. So fundamental stock analysis. This is the process of understanding the past, the present, and the potential future prospects of a company by taking into account basically anything you could take into account. Their sales, their financials, their rate of growth, their profitability, their health, the industry health, where's the industry headed, the management team's competency, much more. Literally anything that could affect a company, you can factor into your calculations for a fundamental stock analysis. So in order to start this off, we need to start with the basics, the financial statements. There are three main financial statements: the income statement, the balance sheet, and the cash flow statement. And they all relate to each other, kind of communicate with each other. We're going to break down each one individually, and then we're going to talk about how they relate. And we're going to do it in as simple terms as possible. And I think you'll be able to follow this and then know much more about financials after this brief section. So first off, the income statement, also known as the profit and loss sheet or the P&L. This is the first place you'll typically look at when you're analyzing a company. This shows the overall performance for a company during a time period. Typically that time period is either quarterly or annually. Quarterly being, after the earnings call each quarter, you get a new P&L, you get a new set of financial statements, and then annually those 4 quarterly statements are compiled to an annual report. This starts with sales revenue and then deducts the costs of goods sold, the cost of actually producing the good or service that you're selling. And this gives you gross profit. Gross profit is then decreased by operating expenses, and that gives you the net income. So I have made an example of a fictitious company. It's called Max's Meats. Go figure. It's called Max's Meats. And we've made a fictitious income statement, cash flow statement, and balance sheet. We're going to just start with the income statement right now. Break this down piece by piece. So Max's Meats had $100,000 in sales in its first year of business. The meat business is a good business to be in. Our cost of goods sold, $40,000, and that gives us a gross profit of $60,000. Our expenses, general administrative, this is things like the back office staff, any general expense could fit into here. We have $5,000. Research and development, we were trying to figure out how thin you can slice beef jerky, so we spent $1,000 on our research here in the beef jerky market. Sales and marketing, fairly low, $3,000, because Max's Meats, they just sell themselves. We really don't need much sales in marketing or advertising. So our total expenses here, $9,000. We deduct that $9,000 from our gross profit of $60,000 and gives us an EBITDA of $51,000. Now, EBITDA is earnings before interest, taxes, depreciation, and amortization. Some investors would rather use EBITDA instead of net income because it isn't subject to quite as many fluctuations, but we're not going to get into that on this video. And then our net income is $51,000. So now that we understand the income statement, we need to understand the statement of cash flows. The statement of cash flows takes in the net income and then adjusts that net income by factoring in non-cash expenses, because the net income only tells us so much. So the statement of cash flows displays the change in cash on a given period. Usually that period, again, is quarterly or annually. So the change in cash in that period, it displays the beginning balance of cash within that period and the ending balance of cash in that period. So let's look at our example here again for Max's Meats, our fictitious company, our statement of cash flows. So we have our net income of $51,000. We have a decrease of accounts receivable, or increase depending on the situation. So what is accounts receivable? Accounts receivable is money that we have yet to receive. So we sold some of our product, we sold some beef jerky or something like that, and our customer has yet to pay us. So there's a $2,500 deduction that we need to factor in because we have not received that cash yet. And then on the other flip of the coin, the other side of the coin here, we have accounts payable of $1,000. So this is the opposite. This is money that we have yet to pay in our expenses. So we have a supplier that we had a $1,000 charge. We have yet to pay them. So the cash hasn't actually come out of our accounts, and we need to factor that into our cash flow so we know where we're actually sitting at present day. And then we have net cash from investing. In this case, we're just going to leave that blank because we're going as simple as possible. Our net cash from financing, this would be if you bought an asset like a truck or some fancy beef jerky slicer and you got a loan on it, it would be factored in here. And then we have common stock. So in this example, the founder of this company, which I guess would be me, I'm Max of Max's Meats, added $10,000 to the business in common stock. So I added $10,000 to the business bank account, and that needs to be factored into the total cash position. So we take that $10,000 and we add it to our cash up here of $49,500, and this gives us $59,500, which is the total cash coming into the company this year. Total cash coming in this year. And then we have the cash at the beginning of the period. This is zero because this is our first year of business. So if this was our second year of business and in the first year we had $50,000, there would be $50,000 here. And then cash at the end of the period is just, again, $59,500. If we had that last year $50,000, we'd be adding $50,000 plus $59,500 together, and that would be the cash at the end of the period. But again, this is the first year in business for Max's Meats. I don't know why I do this to myself. Next up, we have the balance sheet. The balance sheet is the last of the three, and then we're going to talk about how they commingle with one another. So the balance sheet displays a company's assets, liabilities, and shareholders' equity at a specific date. It's kind of like a snapshot, usually at the end of a quarter or the end of the year. It's like a snapshot net worth of the company on that specific date. So it begins with cash and cash equivalents, and then it shows changes in the accounts, and then it should end with a balanced account, that's why it's called a balance sheet, of the same amount that it starts with up on the top. And this shows the financial position of the company. Again, it's like a snapshot, net worth snapshot. So if we look at Max's Meats balance sheet here, we can see the cash is $59,500. The accounts receivable money that we expect to come in is $2,500. So in this case, because we expect to be paid from our customer, we're going to add that to our net worth. Because the customer owes us a debt, we're adding that to our net worth. So our total net worth is $62,000 of this company. Our long-term assets and equipment, that is still blank because we're keeping this simple. Our liabilities, our only current liability is that $1,000 in accounts payable. So that's what we owe our supplier, $1,000. That needs to be deducted from our company's net worth. So our total liabilities, $1,000. And then our equity section. First off, we have common stock. So that $10,000 that I added to the company, that needs to be factored into the net worth because, of course, it's within the company's accounts. Retained earnings, this is the total of the company's profits and losses since the beginning of the company. In this case, it is $51,000. And that $51,000 plus $10,000 in common stock gives us $61,000, which is the total equity, the total net worth of the company after all conversions. Our total liabilities and equity combined is $62,000. And yep, that matches our $62,000 up top. So our accounts are balanced and we are good to go. So now we understand what each of these statements does individually. We need to zoom out a little bit and then talk about how they communicate with one another and relate to one another. So starting with the income statement, nothing has changed here. We have our revenues minus our expenses gives us our net income of $51,000. That $51,000 is taken from the income statement and put up on the statement of cash flows. Here, $51,000. So I've color coded this to the cells that should match, the numbers that should match within these three statements, so then it's a little bit easier to see how they communicate with one another. Now, there's nothing, again, changed in the statement of cash flows here. Our cash at the end of the period is $59,500. And then we take that $59,500, and that's what starts the balance sheet up here of $59,500. And then on the balance sheet, this is where we're really pulling numbers from the other statements. This is where we're going to see it kind of all come together and see how they communicate with each other. So we have the $59,500, accounts receivable, $2,500. So that is pulled from the statement of cash flows. And then we go down down to our liabilities to accounts payable, $1,000. Again, that is pulled directly from our cash flows. So that should match. When you're looking at a company, that should match. The accounts receivable should match from the cash flows and the balance sheet. Common stock, again, we pulled that directly from the cash flows. It matches. And retained earnings, this $51,000 should be the same as the net income on the income statement. And then finally, at the end here, $62,000. This matches our $62,000 up above, and we are good to go. This is how they communicate. This is how they commingle with one another. Now, again, like I mentioned before doing this section, you might have to watch this section more than once. That is totally fine. But you want to understand this section. More than any other section, you want to understand this if you're trying to do individual stock picks, because it will help you so much in analyzing a company. Now, this is a brief overview of financial statements. If you want a more in-depth look, there's a book that I really recommend, and it's called A Step-by-Step Guide to Understanding and Creating Financial Reports. I will have that linked below because that is really helpful if you want to go much more in depth, because we could have a 10-hour video just on financial statements. It can get so complex, especially when you're looking at huge public companies with far more accounts and far more expenses and turnover ratios and things like that. We're going to get a little bit more in depth, but I recommend that book if you want to get very in depth on this subject. All right, I know that section may be a little bit complicated. Don't be afraid to watch through it once or twice more. That way you can completely understand what each of those financial statements do, because understanding those will really help you not only in the next sections of this course, but in your investing career as a whole. Make sure you completely understand that information, and then we'll see you over in part 8. In part 8, we're going to solidify that information even better, because we're going to talk about financial ratios, what they actually mean when you're looking at a company, how you can look at specific ratios of a company to compare that to other companies and other industries, and then decide, hey, is this actually an investment I want to dive further into? We're going to talk about various popular ratios and then give examples on how to actually value a company, and we're getting you closer and closer to turn you into a bona fide investor, and this is really exciting. So make sure you like this video, make sure you subscribe to this channel if you like this kind of content, and also if you want more exclusive content, private content, buy alerts, tons of stuff going on, make sure you join the private Patreon link down in the description, and we will see you over in part 8.